What's up, guys? Today we are talking Warren Buffett. Not only that, we're going to be digging into some of his top holdings, and we are going to be trying to draw conclusions together about, what type of dividend stocks he looks for, what type of criteria he sees attractive in dividend stocks, guys. Let's get into it. I'm excited. Um, all right, so you guys probably know a little bit about Warren Buffett. He's a chairman at Berkshire Hathaway. Um, he's known as the most successful investor of all time. Let's see what it says on Google. He's 93 years old, which is pretty crazy to be that, sentient, and to be a chairman on such a large company at that age is astonishing. So, American businessman, investor, philanthropist, and he currently serves as the co-founder, chairman, and CEO of Berkshire Hathaway. Guys, at 93 years old, this guy has a lot of years of experience. He's been doing this for a long time, so it's nice to look at kind of how he handles things. We don't want to get caught up in ever trying to copy or emulate someone's portfolio exactly. But, it's good to study a great like Warren Buffett. And kind of my hope for this video is, in a lot of videos, I feel YouTubers have talked about Warren Buffett does this, he looks for this. The difference here today is we're going to go through, two or three, we'll see what we have time for, of his top holdings, and we are going to try to draw our own conclusions, guys. You can see here I've got a conclusions box, not a lot in it, but hopefully we're going to be able to fill it out together today with a few simple takeaways if we can. So I've pulled up the Berkshire Hathaway portfolio tracker. Guys, obviously Berkshire Hathaway has to release their holdings once a quarter, and they have to do that just because of the scale they trade at. It is a law. So let's take a look at some of their holdings, guys. These are in alphabetical order. And initially what's going to jump out to us is this position in Apple, guys. They have $165 billion worth of Apple shares, and that makes up 44% of their portfolio. And that is a total stake of almost 6% in Apple shares outstanding, guys. That's crazy to me. And I see this percentage of the portfolio here, and it makes me think about all these times when I see this advice floating around. People will say, don't let an individual stock make up more than 2.5% of your net worth, or 5%. Make sure you diversify, all that, guys. Well, what does Warren Buffett think about that? Maybe in a different video we can go over some interviews and clips, but just looking at his portfolio, guys, if he finds a great company like Apple that meets his criteria, he is more than comfortable having, a very large position in it. It did just come out that he trimmed that Apple position. However, it is still making up 44% of his portfolio. That's pretty crazy. So we'll start with Apple. We'll go through some metrics and we'll see what we see, guys. I haven't done a ton of due diligence because I want this to be a very real-time, hands-on type of video. But first thing, let's check out Apple's net income growth, guys. Right here, we see September 2019, 55 billion in net income. What do we see in the trailing 12 months, guys? 101 billion in net income. That's pretty crazy. That's nearly a double in the span of the past 5 years. So, Apple has that strong net income trend. Warren Buffett likes that. He is comfortable holding Apple at, the stake it is in his portfolio. There's been no negative years. So, we could talk about net income growth maybe for our conclusion. Let's look at a few other things, guys. Apple does pay a dividend. We'll dig into that in one moment. but let's look at free cash flow per share, which, as I've mentioned on this channel, guys, this is my favorite metric to use to measure dividend sustainability. So essentially what I mean by that is that free cash flow per share outstanding, that is the dollar amount that is going to sustain the dividend that a company pays out. So let's look at their growth trend here, and we'll see it tells a pretty similar story here to the net income growth. 319 in September of 2019, trailing 12 months, 683, guys. So that's over a double. Their free cash flow per share has actually outperformed, their net income growth in terms of, percentage appreciation, guys. Warren Buffett likes that. I like that. I think we can go ahead and draw that conclusion that Warren Buffett, in his dividend stock screening, likes to see free cash flow per share uptrend. I mean, I'll repeat it again, guys. Apple makes up 44% of his holdings. I mean, just if we can wrap our head around that number. So, you're going to see a lot of people on the internet or, other investors you talk to trying to tell you all about diversification. Warren Buffett takes a different approach, and he looks for quality stocks. He's willing to, take big bets on these quality stocks and hold them for the long term. Let's keep moving, guys. I am a dividend investor, so let's check out, this dividend tab here on Seeking Alpha. We're going to go over to dividend. We'll start with dividend growth. Apple's 1-year dividend growth rate is 4.4%. Their 3-year is 5.39. Their 5-year is 5.63, and their 10-year is 8.22%, guys. I mean, these numbers don't blow me away. However, I think we need to take the correct lens here with Apple, guys. And that is, they're still focused on reinvesting a lot in their company, guys. I don't know if you just saw the news come out the other day. Oh, this came out today, but I think this news came out on Tuesday. Today's Wednesday, February 28th for me. They're canceling their car project plans, and they're moving those employees to generative AI. That's kind of surprising. I feel like they've been working on that car for I think it said over 10 years. Let's not get on a tangent. Okay. I'm prone to getting ahead of myself. So we're talking about dividend growth with Apple. These numbers are not blowing us away. However, Apple has other goals, and that is to reinvest a lot of their free cash flow. They have share buyback programs. And they have a lot of other avenues that they continue to pursue, including, as we just saw, their generative AI space. So, as a shareholder, I'm excited to see kind of how that pans out for them, guys. Obviously, any company that has mentioned AI in the past probably 18 months has got kind of a sentiment boost off that. And, that's definitely been the case with Apple here in these past couple days. But let's look at their dividend safety, guys. And I mentioned before, my favorite way to analyze dividend sustainability, guys, is going to be that free cash flow payout ratio. Here for Apple, they spend, roughly 13% of their free cash flow to pay out that dividend to shareholders, guys. 13% is not a very big chunk, especially, when we've seen their free cash flow per share double in the past 5 years' time. Do we understand that? So, a lot of YouTubers or other investors, they get really caught up in looking at these numbers, what's happened in 3 years, what's happened in 5 years. Guys, we're going to project that. That's going to continue. I think the story with Apple, it's more important to focus on, what could happen. All right, guys, this is the second biggest company in the world by market cap, second to Microsoft, and they're still able to grow net income and free cash flow at an impressive rate. So why, why would they focus too much on, you know, increasing the dividend, you know, at an unsustainable rate, guys? They're not at that stage of the game yet. Okay. It blows me away, but, down the line, they may get a little more aggressive with those dividend increases. We'll have to wait and see, guys. So, we're not going to draw a conclusion here from their dividend sustainability, but, I think that can be included here with this free cash flow per share uptrend. Typically, that's going to lead to a more sustainable dividend. And I guess I'll make a note of that. But it's not going to be one of our main conclusions right now, guys. We're trying to hit, the broad ideas that Warren Buffett likes. Let's keep it moving. What else do we want to talk about? Let's talk about margins, guys. This is very important to Warren Buffett. He likes companies that have, that long-term sustainability, that ability to remain in the market over the long term. And, one of the best indicators of that is a company's margin. Okay. So if a company has razor thin margins, we've seen it with Walgreens. I continue to reference Walgreens, guys. If you need an example of, crappy margins leading to the detriment of a company, study what happened with Walgreens. We're not going to dig into it today. Let's look at Apple's net income margin, 26.16, guys. Their 5-year average is 23.64%. So currently, or I guess in the trailing 12 months, Apple has increased their net income margin on a relative basis to their 5-year performance. That's great, guys. Apple at this stage in the game, they are continuing to get better at finding that bottom line. Warren Buffett likes that. I like that. We also see here the sector median. I'm not really sure where it's getting this 2.5%, because generally I would think the tech sector would have a much more impressive median margin than 2.5%. But, we're not going to get hung up on that. We are going to draw the conclusion. Warren Buffett likes, industry leading margins, guys. That's going to give companies that long-term advantage, that long-term leg up. This video is already 12 minutes and we are still on Apple. So let's try to pick another stock to continue the rest of the video. Yep, we saw here Apple makes up 44.4% of his holdings. If you're superstitious, wow, whatever. For the sake of not making this, an Apple exclusive video, I think it's best if we move on to a different ticker to continue to draw the rest of our conclusions. So, going through his symbols, guys, I've decided Coke is probably a good example to use. You often hear Warren Buffett associated with Coke. He does have that 9.3% stake in Coca-Cola. That comes out to $24 billion of market value, and that makes up 6.5% of his holdings with Berkshire. So, we're going to go with Coke. The ticker is KO, guys. I do want to disclose, I like to be transparent on this channel. I used Apple as the example for net income growth and free cash flow growth. I could have used Coke. However, I don't think it would have illustrated the point as well as Apple did. We do see a net income uptrend here with Coke, guys. However, it just is not as explosive in nature as Apple, guys. So, I do want to make it clear, I'm not handpicking examples, but, I did glance at these tickers to make sure I could make it fit with the video and not be blindsided while I'm going through metrics. We do see that free cash flow per share uptrend in Coke. Again, I went with Apple to illustrate these points, but, it is there in Coke. So, for these conclusions, guys, we're trying to find kind of themes across different holdings in Warren Buffett's portfolio. But at the same time, we do understand, guys, that each stock, we kind of need to take our own lens as an investor. We need to take the full story into account and not really just try to zero in on one metric. Okay. And I just want to make that, clear. Guys, let's go ahead and go here to the dividends tab. This actually took me a second to find, but it's in dividend safety here. We've talked about free cash flow. Warren Buffett loves a cash-rich company, guys. He has been on record stating that. So let's go ahead and look at debt to equity. That total debt to equity here for Coke is 1.62, guys. So, essentially what that means is, the company is not overly leveraged. Okay. Warren Buffett, kind of his take on leverages. It makes sense for companies growing. It makes sense for them to use debt where needed, but they don't want to go overboard with debt or leverage because, that can lead to a lot of issues if things don't go exactly according to projections here. So, for me and for Warren Buffett, guys, he's looking to see this number below 2. Okay. So anytime we see this number above 2 or 200%, guys, that's when a stock is probably creeping up towards that red line for Warren Buffett of, okay, this might be a little too much debt compared to the equity. It's probably one we want to stay away from, in terms of long-term investing, guys. So we are going to put that on our conclusions, guys. I want to think of the best way to word this. And if you guys have any suggestions for me, I'd love to hear them in the comments. I try to reply to all the comments I can on every video. So we'll keep it simple, and we will say not too much debt, guys, is another thing Warren Buffett looks for in terms of his stocks. So far, we got that free cash flow per share uptrend. We have industry-leading margins and not too much debt, guys. Here's 3 conclusions we can draw from Warren Buffett's holdings. What else, guys? There's one more thing I want to cover today in this video, and it is not something that you can necessarily draw from metrics on Seeking Alpha, but, I can't really have a Warren Buffett video if I don't talk or at least touch on an economic moat, guys. So what is an economic moat? Why does Warren Buffett like an economic moat? And, why are economic moats so attractive to us as dividend investors? I head over here to Investopedia. Guys, this is great for terminology questions. If you need a resource like that, if you need something explained in simple, plain language, I would recommend Investopedia or, just a Google search. You're going to be able to find a number of resources. So what does Investopedia say about the economic moat popularized by Warren Buffett? And it refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share, guys. I've got another video where I dig into this a little more. I will link it at the end of this video. But, for me personally, this is how I like to view economic moats. And it's going to be, can a company generate shareholder value 20 years down the line? Okay, so Coke, in theory, should be able to do that. Apple, in theory, should be able to do that. Bank of America should be able to do that, guys. And that economic moat, that wide economic moat, guys, it can come from a variety of places. Let's use Coke as an example. A lot of their economic moat comes from scale and customer preferences. People who love drinking Coca-Cola are theoretically going to continue buying it in the long term, right? And the scale of Coca-Cola's operations allows them to, make any necessary acquisitions or make any pivots into new market segments that they have to in order to keep their business, relevant and operational for years to come. Guys, I say that 20 plus years because, none of us have a crystal ball. None of us can sit here and say, in 30, 35 years, this is going to be the stock that, sticks around and performs best. We're going to be on Mars, guys. None of us can say that. As dividend investors, we like to focus on current opportunities that have, good valuations and should be able to fare well for our portfolio in the long term, guys. We're going to add here economic moat, wide. Oh my goodness. Wide rating, guys. So, we've drawn 4 conclusions. And if you're looking for dividend stocks, I think this is a great place to start. This can be kind of some preliminary criteria, I guess, for screening dividend stocks. Let's go over them one more time, guys. That free cash flow per share uptrend, that's going to allow, the dividend sustainability, as well as it's going to allow them hopefully to increase that dividend, and it's going to continue to compound your wealth for years to come. So we got that free cash flow per share, industry leading margins, guys. This is going to give a company, some wiggle room in terms of an economic downturn. Coca-Cola has been making Coke products for such a long time that they've been able to, essentially create the best margins in terms of the beverage industry, guys. Industry leading margins, very important. Not too much debt. We talked about that being that debt to equity ratio is kind of a quick scan. Typically you're going to see that between 1.5. If you see that number creeping up and towards 2 or 200%, guys, I don't want to say it's over leveraged, but at least for Warren Buffett's taste, as well as, my taste as a dividend investor, I like to see companies with more of a reasonable debt to equity ratio. And then last, this is one you're not going to be able to find on Seeking Alpha. This is not a number. This is a rating. It's very important to understand that, guys. A wide economic moat rating. Can a company generate shareholder value for 20 years down the line, guys? And, when you're analyzing a company and you see that wide economic moat rating, I challenge you as an investor to say, okay, where does this wide moat come from? All right. I got you guys started with the Coke example, consumer preferences, time in the industry. But ask yourself when you're looking at a stock, okay, does this have a wide economic moat? And if the answer is yes, ask yourself, where does that moat come from, guys? Thank you so much for tuning into today's video. I hope you received some value, guys. I'm really happy with the direction the channel's moving. I've got some pretty cool stuff coming out. I do have an interview scheduled with kind of a exercise science and finance double major. And we're going to talk about the importance of physical health and mental clarity on wealth building. I know that'll be kind of a different style video than we usually do, but I'm excited for it. And I think you guys will really enjoy that. So hopefully I can get that out for you guys. Again, this is Cash Flow Cart. Thanks for tuning in today. Feel free to subscribe. And everyone have a great rest of your day, guys. Thank you.